Right, on to chapter 3. Chapter 3 talks about this thing about capital and revenue expenditure, but I don't think this should. I think what we have, the advantage we have as accountants, is that we can see things through the accounting equation, right? So, we said that when you start a business, I mean, it's not even in here, but when you start a business, fundamentally, you have this C and A. The truth is, just add some vocabulary to chapter 3. This thing here, when the money that's put into the business, the money that's put into starting a business, so money borrowed from the owner, more money borrowed from a loan company, is actually referred to as capital income. You see, and I want to use this video to kind of explore some slightly more interesting topics to do with chapter 3. So when this money comes in, you see, if you, for example, you put in £2,000. And you, or let's say £20,000. It's a bit more realistic to buy buildings and everything. Well, I'm only saying buildings. Anyway, £20,000. This £20,000 is usually split up into two parts. You kind of have the bit that's used for the more non-current assets, and the one that's then used to buy some inventory to start off with, just because you might not be able to get goods on credit. So let's just pretend that £18,000 was going to be used on non-current asset. So buildings, equipment, machinery. That £18,000, that £18,000 is what's referred to as capital expenditure. Kind of long-term, right? Capital expenditure kind of makes sense. CapEx, long-term expenditure. The 2,000 bit, in fact, this capital expenditure is also referred to as it's not popularly known as that or called that, non-working capital. Non-working capital. It's just not working, but it's capital. It's invested. Then we have this £2,000 here that starts to work, right? We buy some inventory, and we take that inventory, we change it into, we get rid of it, and we just do different things with it, right? We sell it on credit, we receive money, we buy some more. So the argument is that once you started a business, the running of the business, the profits should really be coming out of this day-to-day running of the business from the working capital. So this is the working capital. So this 2,000 bit is the bit of the capital that's actually working. This 18,000 isn't. So based on that, kind of going on to what this chapter is really talking about, this idea of buying capital expenditure. First of all, it wants you to look at the double entry. I mean, there's nothing to that. Machinery, let's just say you're paying by bank, for example, if you were. £10,000, £10,000, right? A, is equal to L. Well, in this case, or whatever, plus C, blah, blah, blah. But this time you have one A going up and you have another A going down. It's possible that you might have bought the goods on credit. So we could say some kind of loan company. So you bought 10,000 here, 10,000 here. And that's what they fundamentally wanted to know. How do we do the double entry for these assets? Well, it's an asset. It always goes out. The next thing they want you to think about is that, okay, say for example, I actually bought a building. And in the process of buying the building, I paid £10,000 for the building, or let's just say £100,000, and I put an extension to the building. And or I bought a machine in Sweden for £10,000, and I had to bring the machine to London, and that cost me £5,000 to bring the machine. I had to get someone to install it. That cost me £2,000. The question is, what is the cost? What's the capital value? What should I put in this account, in the asset account? Should I put just 10? Should I put 5? Should I add 5 in? Should I add 2 in? We say you add everything. Because the argument is, what is the definition of an asset? All the costs that have gone to bringing it to its normal working condition. And that's 10 plus 5 plus 2, which is 17,000. So this chapter is really driving at telling you that all the costs that bring it to its working condition or increase the value, same here. If you have 50,000 here, £50,000 extension, that 50,000, if you like, is added to the value of the building, therefore increasing the value of the asset, and therefore this building would be now recorded. Fair enough, once upon a time it was recorded at 100,000, you would now add in an extra 50,000. So here you are, you have your building. So that's 150,000 done. Okay, right, and that's kind of the core message here. And it literally is telling us that everything else. So if you pay for so everything else kind of is on a year-to-year basis. So you pay electricity, water, even the goods you're selling. For the 12 months, they're just revenue expenditure, right? So if an asset is there for the long term, you're no intention of selling it after the year. If you're going to sell this thing within a year, well, I'm sorry, it's a revenue expenditure. So how do we deal with that? Well, it's just the same thing. If I'm paying for electricity, well, I have electricity. It's an expense. It's E. And then I have whatever, say £1,000, and I pay out of the the bank, £1,000. It could be, this could have been water. These are purchases, whatever it is. So what am I fundamentally saying? Capital expenditure, A. Revenue expenditure, E. Right? They're both expenditures, aren't they? Right? But one is long term, and the other is, if you like, day to day running of the business. Okay, great. Then that chapter kind of ends with trying to get you to recognize what I mentioned earlier on, that the general journal is where these, when we actually buy these machines, we actually record these things in the general journal, because we can't put them, if you like, in the we can't put them in the other day books, because they're not goods. These are long-term assets, right? So we put them in the general journal. Debit, the source document, if you like, debit machinery, credit, if you like, bank. And that's how we deal with this. Right, and that, if you like, is the core. The final thing is this thing about asking you to look at the, if you like, we keep a register. I mean, that kind of makes sense, right? You want to know that you have a non-current asset register, which you want to know, well, these are expensive items, right? What's the name? What's the serial number? What date did we buy it? How much did we buy it for? If you like, what depreciation methods are we going to use? We'll talk about that in the next chapter. If you like. So these are all key factors that, and you'll see that as you look through this, just the record fundamentally, and you should be able to. I mean, when I say fill it out, I mean it's literally what it is. What's the name? What's the serial number? What's the cost? And just do all those. When did you dispose of it? That kind of thing. And what's the value at the end of the year? Right? Okay, great stuff. So yeah, that's chapter 3. Look at that, and that should kind of give you a heads up for what's going on in that chapter. Great stuff. See you then.